Crossbeam Capital. Brad, you're up. Take it away,
Thanks.
sir.
Thanks,
for joining.
Jimmy. I appreciate you taking the time. Welcome, everyone. I'm going to walk you through Crossbeam and our specific niche strategy as it relates to the Mountain West housing markets, specifically entry-level and workforce housing, which our company has focused on for almost 30 years. So let me quickly walk you through the firm, and then I'll walk you through the market opportunity and the fund that we are raising to address the market opportunity. Crossbeam is a multifamily development and value-add fund manager. We've been around for a long time. My partner Ted and myself have about 30 years of experience each, and we round that out with a team of 5 professionals with about 120 years of direct real estate experience. Here's, to pay attention is to look at the results. And so in some respects, I think this is an interesting story that tells the ability for investors, wealth managers, to partner with managers such as ourselves and take advantage of 30 years of hard work, lessons learned, experience, our operating platform, and our reputation to access the niche strategy which we've developed over time, and with a lot of capital from others, including large institutions, which I'll get through in a minute. So since 2010, as kind of a benchmark, we've completed 45 property exits, which represented roughly $300 million worth of capital, $2.3 billion worth of total aggregate transaction volume, over 12,000 units, and we have delivered an IRR north of 34% at the property level. The firm was born as a management spin-out by New York Life Investment Management from my career at Fannie Mae. I was the director at the American Communities Fund, which was the largest workforce housing fund in the nation. And our job was to go to the 26 largest markets in the country and help mixed income deals by becoming the largest equity investor in those deals. And so over the course of a 15-year career there, learned a lot of lessons around capital gains on neighborhood, when is too soon, when is too late, and generally a lot about the development business, a lot about risk management, etc. My partner brings varied and different experience to the table, which is extremely helpful. So my partner Ted ran and started off at Bank of America and in originations back in the late 80s. In the 90s, he did workouts at Bank of America. He then joined a multifamily operator and built their platform up to 19,000 units, merged that into a publicly traded REIT called Walden Residential at the time. So Ted is one of the most experienced operating partners you will find in the multifamily business. Here are just a few of the large institutions that we have done business with. So we co-sponsored 2 funds with New York Life Investment Management between 2007 and 2013. We rolled those up into a large venture with KKR in 2014 through 17, and sold that for the largest return on any investment in the KKR first fund of 55%. Let me just, you're only as good as your last deal, as they say in the business. So in addition to the $2.3 billion worth of transaction volume that we've done, we have transitioned from a institutional format to a private format due to, frankly, demand from the wealth management community, which has grown over time as our success has continued. And so about 2 years ago, we raised in about a 3-week time frame a $12.2 million fund, which was designed to be a co-investment vehicle for folks. The fund itself would be the head of the spear. It allowed us to hunt, kill, skin, and serve with a Béarnaise sauce co-investment opportunities to folks. And we ended up investing in 6 assets. of which 3 of them have been sold, gross asset value of $128 million. We've sold 3 of the assets, returned roughly 68% of the fund's capital, and delivered a roughly 24.7% IRR on the existing assets. The remaining assets are in excellent shape in terms of the development assets working through the process right now, and will be leasing up in the 24-25 timeframe, which is excellent timing from our perspective. The firm itself is really focused on innovative building technology, and the reason that we're focused on it is many places that we build are extremely difficult to build in. And so I will give you the context to why this is important to us. We build on the front ranges of these dynamic Western states. The dynamic Western states have attracted a lion's share of in-migration from coastal and other markets that are not as dynamic. The combination of beautiful surroundings with lots of open space, the mountains, 300 plus days of sunshine in most of these markets surrounding the Rocky Mountains, excellent outdoor opportunities, which is attracting highly educated workforce to come to Colorado. So Colorado, for example, has gained 14% in population between 2010 and 2020, and will add another 2 million folks, just the state of Colorado, out of a 6 or 8 state area which we're focused on, which goes from New Mexico to Idaho. There's a lot of dynamic opportunities for us to build, but costs in the mountains are twice as what they are on the Front Range. And so using offsite technology and using what is called building information management, which allows us essentially to work with our architects and engineers and completely design the building, and then share that with offsite construction partners that we have, either panelized or modular, to look at pricing each asset that we have in these very difficult to build places, both from a stick-built, a modular, a panelized perspective, to make sure that we can take advantage of real needs in the community, but headwinds as it relates to in-market capacity to build. So let me quickly talk about the overall market opportunity here that this fund is addressing. If you're not aware, the Mountain West states have a significant housing crisis based on the combination of the in-migration that I mentioned, as well as difficult environments in terms of land. So while there may be thousands and millions of acres of land, there's a lot of topography and there is limited water. And this is going to become a significant issue over time, which may not be as relevant on the East Coast. But water and the Colorado River specifically will drive development. And so there are announcements happening in the state in which multiple municipalities are turning down new developments due to the fact that they do not have water capacity. And so there's a really difficult environment. There is, if you take that on the Front Range, you're looking at the need of roughly 2 million housing units. If you take in-migration, the vast majority of it falls along the Front Ranges of these communities, whether it's Salt Lake, whether it's Denver, Boulder, Fort Collins. You're going to find a significant amount of in-migration to those areas. But in the mountains, it is exacerbated because construction costs are much higher, and availability of units was never built. So back in the 70s and 80s, condominiums were built in places like Vail and Breckenridge. Those units served as kind of the de facto rental housing for those communities. And with the advent of Airbnb, and with prices appreciating by up to 75% in some of these mountain communities over COVID, the situation has gone from dire to an emergency in many cases. And so, for example, Crested Butte, which is a good poster child, they have essentially waived a lot of restrictions for housing to allow for more housing to happen. They're increasing densities. They're working with the Forest Service on allowing folks during the summertime to camp in their cars. That's how desperate this situation is. And a lot of these communities are in desperate situation because they're in the hospitality business and this is their brand. And if the folks come to Vail or Aspen or Crested Butte or Steamboat or Jackson Hole, and they can't go out to dinner, there's certain parts of the mountain that aren't open. There's certain restaurants in the mountain which are not open. All of these things really hurt these communities. And to give you an example, the two largest ski owners, Alterra and Vail Resorts, they own roughly 50 mountains in North America. In each one of those mountains, they're providing on average 165 units of employer housing. And they have, so that would add up to roughly 8,000 units of housing across both of the two largest owners, in which they have 21,000 employees. So they're able to house roughly 39% of their total employees, with the rest of the folks out in the market trying to find something. And Airbnb took all of that condo supply off the market. So you have a real exacerbated situation in which folks can't accept jobs because they can't find housing or they can't afford the housing. And so the opportunity for this fund is to work with the mountain state communities, both Front Range and in the mountains, to drive a new construction of modular and panelized apartment units. We're getting better zoning that we will get in most normal markets because certain of these communities have opted in and are being aggressive about trying to attract funds like us to come and build in their area. And so within that context, we have a very attractive pipeline. And then let's add to that the support of the state by passing Proposition 123, which is setting aside $400 million a year to support housing production, including land banking for municipalities to then offer that land and venture to us to build housing, as well as financing options and more tailwinds, generally speaking. So the fund is serving value add and adaptive reuse strategies similar to the tax discussion on the Front Range and new construction in the mountains where there is zero supply. To give you an example, in the Vail Valley, the town just turned down a housing development that they thought would impinge on Ram territory with a need in the community for 4,500 units of apartments today. So we have certain areas that are NIMBY and certain areas that are buying in to help partner with developers such as ourselves. And that's the market opportunity, because you're not going to find any opportunity to invest in an apartment project that has this level of demand behind it. Yes, there is a lot of difficulty in manufacturing these units, but once you're there, you'll have some of the best supply-demand dynamics available. So quickly to walk through the fund, we're targeting 25. We're already at close to $7 million committed from our existing investors. This is the first time that we're really going outside of our existing investors. For individuals, it's $100,000 minimum investment, so we're lowering the minimum. For wealth managers, that's $250,000 combined of your clients. And we have a significant management commitment from myself and my partner, Ted. And here's an important thing for folks to note who may be frustrated by interactions with other managers. We have been oversubscribed for every one of the deals that we have done in the private capital space. And so with this fund, we put together this hybrid fund structure by which the fund will represent roughly 15 to 20% of each investment, but will be the controlling investor. And the investor in the fund will have the ability to co-invest on a first-come, first-served basis before those fund deals are opened up to co-investment to outside parties. So this essentially gives you what the institutionals would call a side letter that gives you exclusive access within a short window before we would accept subscriptions from others. And that's a big deal. That's access, that's control, and it allows you as the registered investment advisor or the real estate investor to get access with the fund. If that's all the time and effort that you can stake into that investment, that's fine. You'll get distributions across multiple investments, and the fund will have its own profile by virtue of its diversity. If you feel strongly about certain investments, you can then co-invest alongside of that. So it gives you greater control and the greater ability to affect how your deployment works across an annual basis. Real quick, as we have delivered 34% IRR, we're targeting something more reasonable in the 14 to 18%. Our firm focuses on under promise and over deliver as a mantra. We have the fees have been right sized by the institutional partners that we've had, as well as the Boulder Investment Group, which is a group of 700 qualified purchasers that invest significantly with us. And that represents some of the capital already invested in the fund. So we have been run through the ringer as it relates to our fee structure and think it's very reasonable as it relates to market level fees. So 1% committed and invested capital versus 1.5%, a standard construction management fee, a capital transaction fee for purchases and sales of 1%, 8% pref in the fund with a 75-25 split distributions. So during the cash flow period of the investment. And then upon sale, 8% to the investors. Investors get 100% of their money back before any other dollars are distributed after that. And then the sponsor gets a catch up on the preferred return previously paid to the investors. And then it's a 75-25 split. So what does that mean? Essentially, we're getting 75 or 25% goes to the sponsor, and 75 at the end of the day goes to the investor. So at the end of the day, in summary, Crossbeam is a niche manager with a really dynamic and interesting space to operate in that's countercyclical. You get to take advantage and leverage as an investor our experience, our relationships, our track records, and our lessons learned over the course of a 30-year career. And for those that have second homes in these mountain communities, I believe that this is also a defensive strategy because we think that taxes for non-occupied second homes are coming down the pike. So from a tax perspective, this could be viewed as proactive. And with that, I will give it back to you, Jimmy.
Brad, thank you so much. We've got time for a few questions here. First question coming in asks, when does this start cash flowing to LPs? What kind of cash distribution schedule can LPs expect?
I will answer that as follows. So in the new construction assets or the adaptive reuse assets, you'll have the investment will be made. It will take 2 years to roughly get through the development or manufacturing of the units for occupancy. Then cash flow will start. Generally speaking, new construction is what I'll call a total return strategy. Although the cash flow can be good once the project is up and running. On the value add side, that's a much more difficult question to answer, Jimmy. So as you know, we're in a negative leverage situation right now on value add assets, and there is reckoning that still needs to happen in order for cash flows to be above anemic or negative at this juncture. So right now cap rates are pushing maybe 5.5. Sellers are thinking somewhere that's 50 basis points less than that. So we've had a 72% decrease in trades in our market area from last year to this year due to the fact that interest rates and cap rate of sellers have not come into view. And then add to that, Jimmy, the fact that insurance and taxes in many cases are doubling for these assets. They're getting further behind that strike price. And so we think over the course of the next 3 to 7 months, we're going to see a reckoning as it relates to existing multifamily and the ability to have that trade and pencil for the buy side.
Yeah, I think we're all anticipating that. Something's got to happen here. Can you do a 1031 exchange into any of your funds, Brad?
So we have done 1031 before. And so the interesting thing about the hybrid strategy is that you are on a co-investment basis, you are entering into that deal at the property level. And that allows versus at the fund level, if that makes sense, Jimmy. And so with that co-investment structure, you have the ability to structure 1031. To be fair, the legal costs for 1031 are not cheap. And in order for us to entertain something along those lines, I think it would have to be in the $2.5 million or greater for a trade due to the complications and expenses related to that. But that's not a big number as it relates to 1031s either.
Okay, time for one or two more questions here. Eddie just asked, does the current interest rate impact the projected yield?
Well, the answer is there is no yield if you don't make an investment. And so, as we were discussing, I think the challenge right now is that bid and ask are, prices have come down 15 to 20%. I think they need to come down another 10 to 15 in order for us to come out of the gate and be able to say to an investor, look, I'm not relying on 99% of my return from the exit. That is not a position that we're generally comfortable with. So as we're looking at value add and yield, I think there's going to have to be more reckoning that's happening, because we believe, based on our underwriting, that taxes and insurance have increased roughly $675 a unit. And if you carry that forward through a pro forma, that's another 10% of value diminution because of increased expenses that are happening. And that's part of kind of the new world of global warming, in which, whether it's forest fire or hurricane events, we're seeing massive increases in casualty prices.
Last question, 60 seconds here, Brad, and then I got to cut you loose. Can you elaborate briefly on the taxes on non-resident homes and the hedge that you referenced toward the end of your presentation?
Sure. The best example, I think, is to look at Crested Butte and Steamboat. So, for example, these guys are trying to solve these difficult housing problems. These are smaller municipalities without really a huge tax base, right? Sure, there's houses in Bachelor Gulch that are selling for $25 million, but at the end of the day, these are smaller communities that can't afford the infrastructure that a Houston or a Dallas or a Denver can afford. And so as it relates to the ability for folks to get stuff done, unfortunately, the public policy results about, oh, we don't have any housing, how are we going to solve that problem? Usually that becomes a who's going to pay for it. And within that context, here's what's being suggested right now in various areas around our mountain market opportunity. Lift ticket taxes, increase in sales taxes, short-term rental taxes, and now a new popular item is, if you are not in your home for at least 50% of the days, they want to put a vacant home tax on it, because 70+% of the real estate is vacant, for 50 weeks out of the year.
Very good. Well, Brad, we're out of time. Thank you so much for joining me today. Thanks for sponsoring Alts Expo, and I'm sure we'll see you at a future event of ours soon. Take care, Brad. Thank you so much.
My final pitch here is down at the bottom. If you are interested in getting information on the fund, send an email to investors@crossbeamcapital.com. That's investors@crossbeamcapital.com. And through Juniper Square, you'll get access to the deal room, and you can also communicate with us to schedule a one-on-one call.
Perfect. Yeah, Juniper Square is one of the leading investor portal platforms. So always great to see our sponsors on Juniper Square. Brad, thanks again. Appreciate it.
Thank you, Jimmy.